In this session, we are going to discuss mainly types of financial market. Where first we have discussed about order-driven uh, market, and court-driven market, capital market, monetary market, primary market, and secondary market. So we can find there are some arrows in this slide. It does not have any meaning, right? It's right. You just ignore this kind of arrows. So it's not a process. So it's these are the types of market we are going to discuss today. Let's start from order-driven market. Order-driven markets mean where the buyer and seller, right? The buyer, the people who willing to uh, buy some securities, it may be in the form of investor, and sellers of the securities or stocks or any other form of financial uh, assets. So buyer and sellers display their prices and quantities. Very important, the price and quantities at which they wish to buy or sell a particular security. Normally, you observe the market where you can find a particular price of a stock. So, when you look at the stock market, the stock prices, right? You can find just price of the stocks. You are not worried about how many shares going to sell. They are displaying just price. But order driven market displays both how many shares available at what price. Both sides. Sellers can quote, uh, I want 1,000 shares at the price of 50, or I want to sell 1,000 shares at the price of 25, like that. So they are displaying both price and quantities. At the same time, buyers also mention the quantities as well as price. Say Mr. X want to buy 20,000 shares at 10 rupees, like that, right? So here they are showing price as well as quantities. So buyers and sellers display the price and quantities at which they wish to buy or sell a particular security. The buyer and sell trade with each other without intermediation of dealers. So in the order driven market, there is no space for dealers, there is no brokers. The sellers and buyers can do the transaction each other mutually, right? So there is no space for dealers. So therefore, there is no payment for intermediaries. There is no commission. The key feature is that the counterparties are unknown. Counterparties are unknown. So most order-driven markets are the auction market. Auction you can find, right? Here this is a simple illustration. So here's the buyer. Buyer sometime put notice that he want 20 shares at 100 rupees, and this seller also advertised he is going to sell 20 shares at 100 rupees. So these buyer and sellers are met, their demand and supplies are met. So they both of them do the transaction, enter into the transaction. That the buyer will give cash to the seller, and the seller will issue the shares to the buyer. So here there is no space for the dealers. Here the order driven markets. So if you place an order for 100 shares of ABC stock at 30 rupees per share, right? So you have an order ABC company stock How many stock you want? 100 shares. At what price? 30 rupees. So your order will be displayed in the market and can be seen by people with access to this level of information. So most exchanges charge for fees for such transaction. Here, when you see the order driven market, you can find so both sides, buyer's order and seller's order. So in case of buy order, right, the people who are going to buy. So Mr. A, he want this amount of shares at this price. Mr. B, he want this amount of share, this number of shares at this price, like that, like that. And also the seller side, sell orders, sellers will put the price like this. Uh, he is going to sell 59,100 shares at this price, 42.65. Right. So this kind of information you will see in order driven market. So very importantly, you notice here you can find both price as well as shares. But most of the market you can find just price only. You're not able to see the number of shares. So that is a different market. So if you find both shares and price, number of units and corresponding prices, then it's called order driven market. These are the examples for order driven market. Here you can find quantities, buy quantities at what price, selling quantity at what price. So you can find both information. And advantage, when we talk about the advantages of order driven market, the biggest advantage of an order driven market is transparency. Since the buyer and sellers are enter into the transaction directly without intermediaries, so it has more transparent. And also they clearly disclose how many shares available to sell and how many shares uh, he is going to buy at the particular price. There is no bargaining here. More transparency, more transparent. Right? Here nobody can uh, bargain. So I will give more shares. How many shares? How much you can give? There's no kind of argument, right? Here they will disclose both. So how many available number of shares and at what price. So the biggest advantage of an order driven market is transparency. Since the order book is displayed for investors who wish to access this information, he know everything, how many shares available at what price. So the advantage is that an order driven market may not have the same degree of liquidity as code driven market. We will discuss in detail about the code driven market. So in the code driven market, the presence of intermediaries are there. So therefore they will work for us, and therefore it has more liquidity in code driven market. So therefore there's a guarantee that we can sell or buy shares or instruments. So therefore here the issue is in order driven market um, is what? The liquidity. Liquidity mean what? Within short period of time, within with a less transaction cost, they are able to buy or sell securities. That's a major issue here. So order execution is not guaranteed. So nobody can give assurance, guarantee that can sell or buy a particular number of shares at particular price. There is no guarantee. Now you can compare this order driven market with code driven market. Here, a market in which prices are determined from a bid and ask quotations provided by market makers, dealers or specialists. Market makers mean the brokers, stock market brokers. They make market by facilitating both buyer and seller to meet each other. Right? Market in which the prices are determined. So there are demand and supply forces in the market, uh, and here they decide the price. But in the order driven market, the buyer and sellers disclose both number of shares, number of instrument at particular price. Here you can find only the price, particular price. So uh, when you see the foreign exchange rate in the bank, when you visit the bank, you can find exchange rate board. So you can find the price of the foreign exchange currency, foreign currency, right? US dollar. You can find ask price and bid and ask, but you can observe number of uh, units of currency available. No, they not disclose the number of available currencies, right? So they are showing us only the price, the two types of price, bid and ask quotations, bid price and ask price, also known as the price driven market. Price driven market, earlier one is the order driven market. This one is price driven market. Price driven market, in which market makers, brokers or dealers quote the price. Here, earlier in order driven market, the buyer and sellers are display the price. But here, the market makers are the price. The market makers, which means brokers, are disclose the price. Market makers or dealers quote the prices at which the public market participants are trading. And here, when you see this picture, neither seller or buyer not disclose the price. On behalf of them, the market maker or the broker will quote the price. So this is the selling price, this is the buying price. The market makers provide a bid quote, bid at the time of purchase of a stock, bid quote, and ask quote at the time of sell the stocks, bid and ask. Market makers or dealers, brokers or intermediaries, earn profit from the spread between the two quotes and the turnover of the shares. For example, Mr. X wanted to buy a share from ABC Limited. Mr. A just wanted to buy shares from ABC Limited. At the time, he just called the market maker, broker, what's the price of the shares. And on the other hand, Mr. B is already informed to the broker, and he is going to sell shares. So both information, both seller's information and buyer's information is available with the hand of the market maker, broker. Based on the available quantity, and he makes profit. How he can make profit? He buys the stocks at a lower price and he sells the stocks at higher price. So this is how the market makers, brokers are making profit. Say he may put a price of the stock is 12 rupees, selling price is 12 rupees, and he has brought the shares at 10 rupees. So the spread, the margin is 2. when buy or sell a share, he can earn a spread of 2 rupees in a share. If he sold 100 million, so 100,000 shares, then how much is profit? 2 into 100,000 equal 200,000 is the profit of the particular market makers, broker. And the market makers or dealers earn profit from the spread between two quotes and the turnover of the shares. Here the counterpart is unknown. Here spread here difference between the bid and ask price. So bid price, the price at which the buyer is willing to buy, right? Bid price. And ask price, price at which the seller is willing to sell. Here a share ask price is 12, bid price is 10, then the spread is 2, right? Here see the diagram. The dealer executes the order, the dealer execute the order and post the bid and offer price for the market participants. Here this seller and this side buyer. The seller has made communication with dealer to sell the shares, and buyer also communicate with the dealer. The dealer is a common person, right? He has the information from both seller and buyer. And here the dealer buys a security on his own account from this buyer, right? The dealer buys uh, the stocks from the seller on his own account. On account means dealer's account. And here, and the dealer will sell the security on own account of the dealer, right? The dealer is a middleman. When he is ready to sell the stocks, and the dealer will buy the stocks from the seller. And when buyer comes, the dealer will sell the stocks to the buyer. This is the mechanism of quote-driven market. You see the quote-driven market, you can find this kind of board in banks. They displays exchange rate. You can find bid and ask price. Bid means purchasing price, ask means selling price. Quote-driven market, once the player quotes the prices, it means that they will have to buy or sell the underlay, right? And here order-driven market, orders are placed only buy or sell the underlay, right? So they will disclose the quantity also. Once they disclose the quantity and at a particular price, there is no more flexibility on there. But here they can give, they're disclosing only the price. Both parties are eligible for that. Order execution is guaranteed in quote-driven market because market makers are required to meet a bid and ask prices they quote. Right? When it compare with when you compare the quote-driven market with order-driven market, it has more liquidity because here in the quote-driven market, the dealers are responsible to perform the obligation. So it has more liquidity when compared with order-driven market. So here it is possible because dealers have all the information, all the possible information about their buyer and sellers. So therefore, it has more possibility to buy and sell the stocks. It's mean more liquidity. In a hybrid market, hybrid mean here both features can find in one object. So order driven market. So we have studied what do you mean by order driven market. Especially we can find there is no agent there, and uh, they disclose both quantity and the price. And the code driven market, they are uh, you can find the brokers, market makers, and you can find the price, quoted prices, bid and ask. And you unable to find how many number of stocks are available. So the hybrid market means a market which combines both. It combines, you can find the characteristic of both market, order driven market and core driven market. Anyhow, the dominance of order driven market in this hybrid market, the order driven market influence is higher than the core driven market. So predominantly order driven market. In hybrid market, you can find predominantly order driven market. And here in the quote driven market, here also take quote from the participants via specified specialist increase such low quality. Right, hybrid market, you can find more features about the order driven market, and also you can find quote driven market features. A unique type of market which combines the features of both quote driven and order driven markets. So the best example is Nasdaq. Yes, Nasdaq is the market you can find in USA, right? Nasdaq. So now let's compare the order-driven market and quote-driven market. So in the order-driven market, so order-driven market displays all the bid and ask quotes, right? All the bids and ask quotes, and here quote-driven market focus only the bid and ask quotes of the market. They display all means here volume, quantity, as well as uh, price, and also the possible quantities. So at what price, how many volumes. So that kind of information you can find. Here you can focus only, you can find only bid and ask quotes from the market makers. Here the dominant player in quote driven market is brokers. You have to buy and sell via brokers. The brokers decide the price. Here, the buyer or sellers are decide the price. And order details the quantity and price at which the share may be traded. Right? You can find the detail of both order details the quantity and price at which the share may be traded. And code driven market, you can find order only shares the price of the security, orders only the price of the security. And in order driven market, you can order both how many units at what price. You get to negotiate here in the code driven market, you have to negotiate only with price, but here you can negotiate with both quantity and the price. In order driven market, there is no guarantee for order execution because there is no intervention of intermediaries. So it is less likely to execute the order. And here guarantee of order execution. So you can find a more dominance from intermediaries, market makers. Therefore, we can find so it has more chance to execute the order quickly as possible. And price transference, you can find the price transference. So on what price, how many units. Based on that, you can find the price transference. But here, no price transference. No price transference because they only disclose the price, bid price or ask price. And counterparty is unknown in order-driven market, and in quote-driven market, counterparty is known. It's dealers. Now we'll discuss about capital market. You know, capital market. Uh, Capital market is a market where long-term securities. Most important word is here. Long-term securities like bond and equities are traded. Capital market is a market where long-term securities like bond and equities are traded. Long-term means it mature more after 1 year. It mature after 12 months. When we look at the features of the capital market, here the instruments maturities are more than a year. Maturities are more than a year. Companies, government, public sector institutions can issue equities or bonds. Companies, government or public sector institutions can issue equities or bonds. And the capital market functions through the stock exchange market. Stock normally, the capital market function through well-regulated exchange. Well-regulated exchange. For example, in Sri Lankan context, Colombo Stock Exchange is more regulated market in Sri Lanka. It is monitored by Securities Exchange Commission. So it has rigid rules and regulations. So millions of money is transacted every day. So therefore, so the government is take responsibility to look after the operations. So capital market function through stock exchange market. So what is the goal? What's the objective of the capital markets? To channel, right? They have to find a channel. It means the way to flow the fund, to channel, right? To move, to channel the money provided by servers and depository institutions. Now, people like me and you are having excess money. That excess money will be deposited into the bank. Servers and depository institutions like bank, credit unions, insurance companies, right? These institutions are collect deposit savings from the general public to borrowers and investees through a variety of financial instrument. And right, so that savings will be go to the hand of the borrowers mean the peoples who need money, borrowers, and the investees. So the people or institutes have uh, business ideas to make money, right? New project, investment projects, so they want money. So there are two ends. One group, one end we can find servers and depositors. Another end we can find uh, the borrowers, investees. The capital market helps to meet each other. So therefore, the fund will be flowed smoothly. Right? So the goal of the capital market is to channel the money provided by servers and depository institutions like bank, credit unions, insurance companies, right, to borrowers and investees through a variety of financial instruments. For example, bond, notes, shares, termed as securities. So another side, the people who have excess money put the money into the bank. That the bank will carry that money into the capital market, and in the capital market, many companies, listed companies and governments are waiting in the capital market for money. And once they are getting money for the investment or any other purchases, they will pay interest in the capital market decided by the demand and supply forces, and the profit will be distributed among the savers and depositors. So this is how the capital market works. Now let us discuss about the role of capital market. Role of capital market. So what's the function of the capital market? So why do we need capital market? What kind of operations they are doing in the capital market? Here, it is the only with capital market we can find here in capital market. The long-term funds are raised by the business community. So it has the only one option. Capital market is the only one option to find a long-term fund by the business community. It may be in the form of bank or whatsoever. If a business borrow a loan from bank, the bank is a capital market, because if they are getting long-term mutual fund loan, so therefore we can say that it's the only option to the business people, business communities, to get long-term funds. Number two, mobilization of savings. Mobilization of savings. Here there are a lot of savers, iron white, but the contribution of each savers are small portions. Here I can say only 5,000 per month, or 10,000 per month, 20,000 per month. But individually, it is not enough to finance two businesses. So the banks, as a middleman, the banks will collect all of the savings from us, from the general public, and that savings will be moved to the capital market. So because the availability of the capital market, because of the capital market, the savings, the general public savings, are moved to the capital market, and it is invested there and get returned. So mobilization of savings provide opportunity for the public to invest their savings in attractive securities, which provides a higher return. If there is no capital market, we are unable to find an attractive investment pool. Provision of investment avenue. It gives an opportunity to invest, to make an investment. Capital market gives us an opportunity to make a good investment, to know the trend, different securities and conditions prevailing in the economy. Due to changes, due to the many factors, the economy will change. So in the trend of economy, time to time, the investment opportunities will be varies. So during this pandemic, many industries are facing difficulties in their business. Some businesses are lose their all total business. Say for example, travel agents, hotel, especially hotel industries. During this pandemic, they have almost no business. But there are in this time, investment on the hotel industries is not a good option. But when we look at the share prices, investment on hospital industry, hospitals and healthcare, and especially the telecommunications, now everybody relies on online service providers like Sri Lanka Telecom, Dialog, Mobitel. So they are investment on investment in such companies, they give us more profit. So all such companies are comes to finance capital market, right? So due to the availability of capital market, we can find it provide us for the investment avenue. So we can find to know the trend of different securities and the conditions prevailing in the economy. Speed up economic growth and development through capital formation. So well-developed capital market will help for the economic development, right? The people who have a good idea, investment project idea, but they does not have investment money to start up their business. And another end, there are people, they have no business idea, but they have excess money. So because of the capital market, the excess money will be invested in the excess money will be bring into the capital market, and the people who have an investment idea come to the capital market and get that money and they do the business. So due to this process, many the production will be increased. There will be many investment projects, startups. So due to that, many employment opportunities will be created and GDP will increases. Standard of living will be increases, right? So the capital market will speed up the economic growth and development through capital formation. If the savings will be put into the capital market, that say therefore that saving will be converted as investment. So well-developed capital market is capable of attracting funds even from foreign countries. Now, if the capital market is more efficient, then it will be attract to both investors as well as the borrowers. And if it is more efficiently works, it will give more profit for the investors. And another side, and it is more cost effectiveness for their borrowers. So if capital market gives more profit and attractive schemes, then even the investors are come from abroad, right? So why people are willing to invest in American exchange? Why they are invest their money in New York Stock Exchange rather than putting the money in the CSE? Many people, many investors are willing to invest their money in the New York Stock Exchange rather than local one. So why? So when compare with other markets, the New York Stock Exchange is more effective, right? It attracts more investors because of the efficiency. So therefore, the industries in USA, they are getting more opportunity for the economic growth. And also continuous availability of fund. Every time you can find money from the capital market. Capital market all the times are ready to give money if the capital market is more efficient. So these are the roles of capital market. Now we look at about the importance of capital market. A market that works as a conduit for demand and supply of debt and equity capital. Here you can find the savers and depositors, especially institutions, and here borrowers. Here in between the borrowers and savers, capital market is working on. The savers, the institutions will supply money, and borrowers sell the securities here and get the money here, right? So this is the basic mechanism of capital market. And you see the capital size of the capital market. The largest market is foreign exchange market. The worth of this market is 955 trillion US dollars, and derivatives, the trading is 601 uh, dollars, and the value of traded shares 87 trillion. So world GDP at that time 63 US dollars. Let us discuss about in detail importance of capital market. Number one, the capital market serve as an important source for productive use of economic savings. Imagine absence of the capital market, absence of banks. So think about, where in the absence of capital market, no people will motivate to make savings, and also the people who have a good ideas, good investment projects ideas, they will given up the ideas. But if they find an efficient capital market in the country, the business people having a good business idea have a hope to get the fund in the capital market. And also the savers are motivated to save money, and that money will be invested in the capital market. For that they will get interest as a return. So savers also get benefited and motivated, as well as another side borrowers are also motivated. The capital market serves as an important source for productive use of economic savings. It mobilize the savings of people for further investment, and thus avoids their wastage in unproductive uses. Therefore, in summary, the capital market helps to mobilize the savings to capital market, and the savings will be used in a productive manner for the development of economic growth. And number two, it provides incentives to saving and facilitate capital formation by offering suitable rate of interest as the price of capital. It provides incentive to saving. When savers are getting more and more interest, they will motivate to save, save more. And that saving will be converted into investment by the business people, and they will get capital at reasonable price. It provides an avenue for investors, particularly household sectors, to invest in financial assets which are more productive than physical assets. Right? So when you put your money into the bank or other investment tools, you can get, sometime you may not, sometime most of the time you will get more profit than investment on physical assets. Right? Say for example, today the share price is 10 rupees, you purchase 10,000 shares. The next day the share price become 11 rupees, 1 rupees increase. Then you have how many shares? Then you have 10,000 shares. So in a day you can earn profit of 10,000. If we have 1 million shares, if share price increase by 1 rupees, you can end up with 1 million rupees as your profit. So this kind of profit is possible, especially for individuals when they make investment on financial assets. And also you have to keep in your mind there is a risk. That's a risk. If you are expecting high return, and of course and also you have to ready to take higher risk. And it facilitate, capital market facilitate increase in production and productivity in the economy, and thus enhance the economic welfare of the society. So due to the movement of cash between servers to the investors to the business, it will increase the production and productivity of the economy. So due to that, many people get jobs and many people get higher income. So therefore, it will enhance the welfare of the welfare of the society, and they can enhance their standard of living. And thus it facilitate the movement of stream of command over capital to point highest yield. So it is possible because of the higher return on the investments. So towards those who can apply them productively and profitably to enhance the national income in the aggregate. And number 5, the operation of different institutions in the capital market induce economic growth. It will definitely, the capital market helps to induce the economic growth. So they give quantitative and qualitative direction to the flow of fund and bring about rational allocation of scarce resources. You know, money is the scarce resources. In the capital market, we can observe, we can make a research, make some analysis to find the best investment opportunities. So the investment opportunities, so the capital market will guide the investors on profitable investment pools. Number 6, a healthy capital market consisting of expert intermediaries promotes stability in values of securities representing capital fund. And in a good capital market, in a healthy capital market, we can find brokers who are expertized, who are expert in dealing with capital market products, instruments. So the intermediaries, the expert intermediaries will promote stabilities and value of securities representing capital fund. Right? The brokers, the experts will guide the investors. So therefore, it will enjoy a valuable, stable, stable capital funds. And moreover, it serves as an important source for technological upgradation in the industrial sector by utilizing the fund invested by the public, right? So due to existence of a well established capital market, it moves the fund from general public to the capital market, and it helps to upgrade the industry, technological industry. So some period more technological companies will go to the market to expand their business in technology wise, technically upgrade their businesses. So it will help for the upgradation of technology upgradation of the industry. So capital market plays a major role by supplying, major role in developing, upgrading industries, technological upgrading of industries by providing fund at needed time. Thus, capital markets serve as an important link between those who save and those who aspire to invest their savings. Right? So the capital market is a place, it serves to bring all the savings, and that savings will convert into investment, good investment pools. See the capital market structure. we can divide the capital market into primary market and secondary market. Again, the primary market is divided into a newly issued bond and newly issued stocks, equities. So due to these primary market operations, the money will flow to the issuers, organization or institutions or companies. In secondary market, right, uh, they are trading old bonds and old equities. There is no more cash flow into the companies, issuing companies. Now let us discuss about money market. Financial market, we can divide the financial market into two. First one is capital market. It is we discussed now earlier. We have discussed, and so capital market is rising of long-term capital. It helps to raise a long-term capital, and the money market helps to transfer of liquidity, short term. That's in the short term. If anybody want money, a short-term basis. So some people, in our experience, we can find people like people may ask, can you give some amount of money? I can settle it in 2 days or 5 days, 6 days, 1 month. I can return the money in 10 days, within 1 month, within 2 months, 30 days. So this kind of transaction will be take place in money market. So the major thing is the primary objective is transfer of liquidity. Transfer of liquidity. So in urgency, in case of urgency, they are supplying money. So money, so liquidity. Liquidity means we can convert we can convert any assets easily into cash in relatively very small cost. So the market, the money market. What is money market? The market where financial instrument with high liquidity and very short maturities are traded. So best example is check. The current account, bank check. This is most liquid assets, most liquid financial instrument, check. Right. So what is money market? A market for short-term financial assets. A market for short-term financial assets that are close substitutes for money. Those are a close substitute for money. Think about the check. And facilitate the exchange of money in the primary and secondary market. Right? So money market for the short term, very important one, short term financial assets that are close substitute for money. It's a substitute for money, and facilitate the exchange of money in the primary and secondary market. The features of money market, who are the major players in the money market? Government bodies, institutions like EPF, ETF, pension fund, central bank, like individuals like people, you and me, right? So these are the major players. So when you talk about the duration, so normally the short term, right? It may be start from 1 day to 1 year, up to 1 year maximum. If goes beyond 1 year, it will consider as a capital market. So to consider capital markets, it's fall in 1 day and 1 year in between this. Locations, normally we couldn't find the locations, so it's most of the times a system, virtual system, right? With the phone call or the memo request, email, they can request money. So not a place, so it's a system, right? It's a system. And mode of transactions, normally is telephone, fax, email, right? That kind of things. And type of trade, so over the counter and over the counter. in oversell. There's no, so when you consider, when you concern about the capital market, there are a lot of procedures, lot of forms, lot of agreements, right? It takes time. It's a long process. But when you take about money market, here, so process are very simple, very quick manner. No, there are some documents, but it's not like capital market. And role of the money markets. So the money markets helps to financial mobility, right? Fund mobility. It helps to uh, mobilization of fund, and it's promote liquidity and safety, right? Liquidity and safety. If there are, if the existence of a well established money market, the companies or firm business people not don't worry much about liquidity. Whenever they need money, they can go to the money market and get the money immediately. And it also it give safety. So if there is no money market, sometime they will end up with bankruptcy, right? And demand and supply, it balances both demand and supply. It the money market generate a demand for money and supply for money both. And economy in use of cash, right? It's it provides a loan, a short-term loan in a small percent of interest. So economy, right? Cost effectiveness, money market. So when you talk about the instrument traded in the money markets, treasury bill is most important one. Treasury bill, commercial papers. So treasury bills issued by the government, and the commercial papers are issued by companies. And call on notices, sometime we call as interbank call money market. And the repurchase agreement, repurchase, sell the stocks and sell the instrument, again they are purchase, repurchase. And deposits, certificate of deposits, these are the instruments used in the money market. The money market does not deal with cash but substitute of cash. So major players in the money market, here we can find issuers, the government, bank, financial institutions, corporations. On the lender side, we can find the mutual fund. The issuers mean the parties who need money, issuers, and the lenders mean the people or the parties who have excess money. They issue the securities and they buy the securities. They pay money and get the security. They issue the securities and get the money. So lenders consist of mutual funds, foreign institutional investors, and banks. Intermediaries are central banks and dealers. So when we look at the participants of the money market, financial institutions like banks, insurance companies, like that, investment companies, and federal means governments, state agencies like central bank and securities exchange commission, like that. And trading companies, retail banks, commercial banks, and merchant banks, and cash management programs. So these are the participants of money market. And functions of money market, here it financing trade. So it gives money for trading activities, trade, financing trade and financing industry. Some companies need money immediately, they need money. Banks need money immediately. So that time it helps to safeguard the industry by giving the money. Profitable investment. So the capital market will give investment opportunity to the lenders, servers. Self-sufficiency of commercial banks. Sometimes if commercial banks need money to settle, to settle the check, big amount of check. Sometimes they need a big amount of money. So that time they can get the money from another bank using call interbank call money market. So they get, so it's safe banks, commercial banks, support to central bank, right, to finance the government like that. So these are the differences of the capital market.